In this video, we calculate the precise break-even points and profit scenarios for the long straddle. To construct a long straddle, we purchase an at-the-money call and put at the same strike. Because we are paying two premiums, our initial cost basis is significantly higher than a simple directional trade. This total debit represents your maximum risk and sets the bar for your profitability. To calculate your expiration break-even points, you simply add and subtract that total debit from your chosen strike price. The stock must move beyond these outer boundaries by expiration to generate a profit. If the stock remains inside this range, you will experience a loss due to theta decay eroding the premiums. Let's apply this to a real-world example using stock XYZ at $100 with a $5 total straddle cost. Your upper break-even is $105, and your lower break-even is $95. If the stock sits exactly at $100 at expiration, both options expire worthless, and you realize the maximum loss of $500 per contract. The profit and loss profile creates a V-shape centered on the strike price. The area between your break-evens is the loss zone. However, once the price breaches a break-even, profit potential becomes technically unlimited to the upside and is capped only by the stock falling to zero on the downside. Crucially, you do not need to wait for expiration or for the price to hit these break-evens to profit. As discussed in our volatility phase, an increase in implied volatility will inflate the premiums of both legs simultaneously. This allows you to sell the straddle for a profit early, even if the stock price hasn't moved the full expected amount. Thanks for watching, and next we will cover how to manage a straddle during high volatility.